This MCQ is testing the enhancing qualitative characteristic of comparability under the conceptual framework. Comparability allows users to identify similarities and differences over time and between accounting methods. The key issue is a change in inventory valuation method from FIFO to weighted average. This is a change in accounting policy, not an estimate. Therefore, it is governed by IAS 8 principles. Changes in accounting policies should generally be applied retrospectively, unless impracticable, to ensure financial statements remain comparable over time. The question asks specifically how comparability is achieved when a change in inventory valuation basis occurs. The change should be disclosed only. Incorrect. Disclosure alone does not ensure comparability. Users need consistent figures, not just explanation. The financial statements for March 31, 2026 should show both methods. Incorrect. IFRS does not require dual reporting of both methods in primary statements. This would reduce clarity. The notes should show what the profit would have been if the change had not taken place. Incorrect. This introduces hypothetical figures, which is not the IAS 8 approach for policy changes. The financial statements for the prior period as shown at March 31, 2026 should be restated using the weighted average basis. Correct. This is retrospective restatement, ensuring both current and prior period figures are comparable under the same accounting policy. Final answer: restate prior period financial statements using weighted average basis. This ensures consistency, comparability, and faithful trend analysis, which are core objectives of the conceptual framework. This MCQ tests knowledge of IAS 40 investment property and how it interacts with IAS 16 property, plant and equipment, PPE. The focus is on classification transfers between investment property and owner-occupied property, and the measurement rules applied at the point of transfer. Students must understand two core ideas. Investment property classification changes only when there is clear evidence of change in use, not arbitrary reclassification. When classification changes, accounting treatment depends on fair value measurement rules at the transfer date. Statement 1 correct. IAS 40 allows transfers only when there is a change in use, such as moving from owner-occupied to investment property or vice versa. This prevents manipulation of classification for earnings management. Statement 2 correct. When an investment property is transferred to IAS 16, i.e., it becomes owner-occupied PPE, the asset is measured at fair value at the date of transfer. This fair value becomes the deemed cost under IAS 16 going forward. Statement 3 incorrect. When transferring from IAS 16 to investment property, any difference between carrying amount and fair value is not treated as an expense. Instead, it is treated according to IAS 16 revaluation rules. Gains may go to OCI, revaluation surplus, not profit or loss in most cases. So the statement wrongly assumes an immediate P&L expense. Correct answer: both statements 1 and 2. Exam tip: always remember, IAS 40 transfers equals change in use, only transfer measurement equals fair value at transfer date. Critical rule: not all remeasurement differences go to profit or loss. This MCQ tests knowledge of capitalization of development costs under accounting standards, IAS 38 intangible assets. The key issue is understanding when development expenditure can be recognized as an asset rather than expensed. Under IAS 38, development costs can only be capitalized when strict criteria are met, including technical feasibility of completion, intention to complete and use/sell the asset, ability to generate future economic benefits, availability of adequate technical, financial, and other resources, ability to reliably measure attributable costs. The question asks specifically, which condition would disallow capitalization of costs? So we must identify the option that violates a fundamental recognition requirement. A. Development is not yet complete. This alone does not prevent capitalization. IS 38 allows capitalization during development if criteria are met before completion. B. No patent has yet been registered. Patent registration is not required for capitalization. Legal protection is not a recognition criterion. C. No sales contracts have yet been signed. Future sales contracts are not necessary. Expectation of economic benefits can be based on market demand, not existing contracts. D. It has not been possible to reliably allocate costs to development of the product. This is the correct answer. IS 38 requires reliable measurement of costs. If costs cannot be reliably measured and allocated, the asset cannot be recognized, and all expenditure must be expensed. Final answer, D. This option directly violates a core recognition principle: measurability of cost, making capitalization inappropriate.